Imagine a mountain of debt so massive it outweighs the entire gross domestic product of several small nations combined. 91,000 crore rupees. When that amount of money vanishes, it threatens to take an entire national economy down with it. This debt belonged to Infrastructure Leasing and Financial Services, or IL&FS. For 30 years, they were the silent engine underneath India's growth, financing the highways, ports, and power plants that defined modern infrastructure. When their financial architecture cracked in 2018, credit markets froze. Panic spread through banks and mutual funds in a matter of hours. Analysts quickly realized they were watching India's own Lehman Brothers moment unfold in real time. Yet, right up until the collapse, the market treated the company as a perfectly safe investment. They commanded immense credibility because their major shareholders were institutional titans like the State Bank of India and the Life Insurance Corporation. Because of this strong link to state-owned entities, investors assumed the government would step in to cover any losses if things went wrong. This implicit guarantee created a dangerous moral hazard. Capital flowed in without scrutiny because everyone assumed the company was too big to fail. This diagram shows the core mechanical flaw that broke the company, an asset-liability mismatch. IL&FS was borrowing money using commercial paper, loans that demand repayment in just 90 days. But they were using that fast cash to build projects that take 10 to 20 years to generate toll revenue. To survive that massive cash flow gap, they had to constantly take out new short-term loans to pay off the old ones. They were operating exactly like a bank, but completely bypassing the strict regulatory oversight a real bank is subjected to. As the borrowing accelerated, management needed a way to obscure their mounting liabilities. They split the organization into a labyrinth of 347 separate subsidiaries, scattering the debt across hundreds of different balance sheets. This hidden debt physically manifested as the concrete and steel of major national highway networks and power grids. The entire model relied on a single fragile condition: the market's willingness to keep lending them fresh money. As long as lenders kept rolling over the debt, the illusion of solvency held together. That illusion shattered in June 2018. One of the subsidiaries delayed a seemingly minor repayment of 450 crore rupees. It was the first hard signal that the endless supply of short-term cash had finally dried up. When investigators from the Serious Fraud Investigation Office finally opened the books, they found a system running on deception. Loans were being round-tripped, moved from one internal subsidiary to another just to artificially inflate the health of the balance sheets. Incredulous! Look at this chart. Management officially reported a profit of 1,800 crore rupees for the year. But when the accounts were properly recast during the investigation, that supposed profit collapsed into an actual, devastating loss of over 7,500 crores. Through all of this, the institutions meant to protect the public were looking the other way.
Top auditing firms were collecting massive fees, and credit rating agencies continued to give IL&FS their highest possible AAA safety rating, right up until the defaults began. The watchdogs were asleep. This was an absolute systemic failure of every check and balance designed to protect investors from reckless corporate gambling. Once trust eroded, the panic was immediate. In September, a major mutual fund started dumping the commercial paper of other shadow banks at steep discounts. The fear was simple. If a giant like IL&FS was hiding massive losses, who else was lying? The domino effect hit the stock market with brutal force. In a single trading session, the Sensex plummeted by 1,500 points as liquidity completely vanished from the debt markets. The collateral damage extended far beyond corporate boardrooms. Millions of retail investors, retirees, and pension fund holders suddenly realized their life savings were trapped in a collapsing ecosystem. The threat to the national economy was so severe that the government took extraordinary action. They superseded the company's board entirely and installed a new resolution team, led by veteran banker Uday Kotak, to salvage the remaining assets. A single delayed payment, deep within a web of 300 subsidiaries, was all it took to freeze credit markets and nearly crash a deeply interconnected financial system. The mechanics of the IL&FS collapse expose the primary vulnerability of the modern global economy, the choke point dependency. Both systems operate on the assumption of frictionless, continuous flow through a single, narrow gateway. Just as IL&FS collapsed when short-term cash stopped flowing through the narrow window of market trust, the global economy faces a physical mirror in the Strait of Hormuz. Roughly 60% of the world's oil supply is bottlenecked in this single, narrow geographic gateway. When that logistical gateway is restricted, the physical, short-term flow of energy stops. Refineries are instantly forced to run at 100% capacity without a break, just to maintain a baseline of basic fuel output. This forced prioritization starves the rest of the interconnected system. Without raw energy flow, the feedstocks for plastics, fertilizers, and critical manufacturing simply cease to exist. We have built a world that operates with zero buffer. Whether it is just-in-time cash or just-in-time fuel, our global economy relies on highly fragile logistical arteries that are increasingly easy to disrupt. When these physical gateways fail, the financial math catches up instantly. Supply shortages trigger runaway inflation and the rapid devaluation of the currency sitting in your bank account. Whether the government is bailing out a massive corporate failure or you are paying double for groceries because of a global supply disruption, the end result is the same. The everyday taxpayer acts as the ultimate shock absorber for systemic fragility. Assuming that regulators will protect your money or that massive systems are inherently safe is a luxury we can no longer afford. When the next systemic link breaks, how are you proactively inflation-proofing your wealth?